In Dhirendra Kumar. Dhirendra, we've had questions from viewers asking us where to invest money for short periods of time, whether it's a month or 2 months, maybe someone who's looking to buy a home who wants to keep that down payment money safe until they find the home. What would you recommend such an investor do?
There are two kinds of investors who look at such short time period. One is a real investor who has some money and who is planning to spend, waiting for the daughter's wedding, or waiting to make the down payment for the house, or the money is put to work while your child's admission for a course is due. So if it is one such thing, then you should consider nothing else but a liquid fund, or let the money lie in your bank account, or do a short-term deposit, a short-term fixed deposit, because exactly for the time frame, don't consider anything else. Don't even consider taking a chance on that money, and you should be sure that those investments never go down in value. But I also come across a lot of investors who think that they have the money for many years, but they don't want to invest for many years. They want to keep the money on demand every 2-3 months. I don't think I have any suggestion for them. I can only persuade them that if this is your long-term money, be guided by your objectives. Be guided by when you are likely to need the money. If you are unlikely to need this money for many, many years, then start investing your money gradually in the market, and don't think in terms of trying to make a quick money. Because if you're trying to perfectly time the market, if you think that the elections will cause some kind of turnaround, or you can profit from it, or if you want to ride the momentum in the market over the next few weeks, that is the wrong way to approach the market. You will generally be disappointed, and you will be investing mostly at the wrong time.
But the other question that investors ask us is, what is the difference between a liquid fund and an ultra short-term debt fund? So if we are choosing between one of the two, how do we decide which one suits us better?
The key difference between a liquid fund and an ultra short-term fund is that liquid funds are not allowed to invest in any security, any bonds or money market instrument which has a maturity of more than 60 days. So all those, and by holding by following such a stringent guideline, they tend to be very stable. They never go down in value. In their life they have gone down in value only once, and many of them on a historic opportunity last year, but generally they don't go down in value. And because the residual maturity of the bonds which these funds hold is such that they are valued differently. So compared to that, ultra short-term bond fund are also like that, but it is not a mandatory stipulation for them. Generally, these funds don't go beyond maturity of 90 days. And ultra short-term bond fund and liquid funds tend to deliver the return in a very narrow range. Compared to that, ultra short-term bond funds are able to deliver little more return than liquid funds.
Well, how should we then choose our liquid funds or our ultra short-term funds? Because even within that category, there are so many choices across different fund houses. How would you recommend we line up the criteria and choose?
You have two things to look at when choosing a liquid fund or ultra short-term bond fund. One is to look at the expense, because everything else being equal, liquid funds are entirely guided by expense. The cheaper the fund, the better, more likely that it will deliver superior return. But the difference between various liquid funds they operate in a very narrow range. So that is one. Look at the expense and look at the returns. I would say that there are some fund companies which tend to deliver little more return, simply because they charge less. So I would say the combination of returns and expenses, and generally both of them help you arrive at the same fund.
Alright, so there you have it, a list of how you should choose a liquid fund or an ultra short-term debt fund. We have a couple of questions from viewers. Dhirendra Shrikant has written in. He wants to invest 6 lakh rupees in a stable mutual fund with medium risk. He wants to get good dividend returns even if the market falls. So there are funds that specifically do just that. Would you recommend a few for him?
I would say that if you're investing for a few years, then you should not be looking at dividend, because your goal should be to accumulate your investments or grow it rapidly. And the other important thing is to don't invest all your money at one go. Investing 6 lakh rupee and watch it decline to 5 lakh 50,000 rupee can be quite unnerving. develop a belief system, invest regularly, spread this investment over the next 12 months, even if it is at the cost of missing an opportunity just in case the market goes up. It will be to your disadvantage, but it is very important to build that habit of gradually participating in the market. And the kind of return you are expecting, balanced funds can well deliver that. But important thing is spread your investments over 1 year. And if you are looking at, if your investment is not for 5 years and more, don't even follow my plan.
All right, let's take another question. Preetham has written in, he wants to invest 10,000 rupees this month in a mutual fund. He wants some options to save tax using mutual funds under 80C. Dhirendra, assuming he can put 10,000 rupees every month, would you recommend he uses an SIP instead?
When it comes to market-linked investment and saving taxes, you have tax-saving funds. Besides that, you can well consider your PPF, NSC, and all the conventional guaranteed income tax-saving alternatives. But if you want to invest 10,000 rupee, I would say that 10,000 rupee one-time investment is unlikely to make a huge difference to your life. But even considering 2,000 rupee SIP for a long period of time can make a big difference, and also help you develop a belief to accumulate some significant saving, accumulate wealth over time. So consider that. This one-time investment, first-time investor, as I always suggest, that consider a good balanced fund.